Imagine using an artificial intelligence tool to legally save your company $100,000 on taxes today, only for that exact same AI to cost you like $175,000 in brutal penalties a year later.
Yeah, it's a terrifying scenario.
It really is. Welcome to the deep dive. Whether you are prepping for a high-stakes board meeting or trying to scale a startup, or you're just, an insanely curious learner looking for clarity without the overwhelm, you are in the right place.
Absolutely.
Today, we're exploring a massive collision happening right now in the corporate world. We're looking at the messy intersection of artificial intelligence, high-stakes corporate compliance, and the incredible complex labyrinth of research and development tax credits.
It's really the perfect storm of innovation meeting bureaucracy. I mean, we have these entirely new, rapidly evolving technologies colliding head-on with very old, very strict tax laws, laws that were, written decades before machine learning even existed.
Right, exactly. And to figure out what is actually happening on the ground, we are synthesizing a huge stack of sources today. We've got highly classified executive intelligence dossiers, recent U.S. tax court rulings spanning from 2024 to 2026, and some deeply revealing strategic market analyses of AI startups.
A lot of material to go through.
It is. But our mission for this deep dive is to uncover why simply throwing an AI at complex financial tasks isn't the magic bullet everyone thought it was. In fact, we're going to see how the most successful, resilient companies are actively building, human bottlenecks back into their technology. Okay, let's unpack this.
I think defining the financial stakes is the best place to start because the numbers involved here are just staggering.
Yeah, let's hear it.
Well, when the business world talks about AI automating financial compliance, the default assumption is that efficiency is always a net positive.
Sure. Moving faster, cutting out the human middleman.
Yeah.
That seems like the ultimate goal.
Exactly.
Yeah.
But in the realm of the IRS and the federal tax code, autonomous efficiency can actually trigger a total financial catastrophe.
Let's put a concrete scenario to that. Imagine you run a mid-sized software company, and you decide to use a fully automated, hands-off AI platform to claim a $100,000 research and development tax credit.
Right. A very common scenario these days.
Right. So you think, fantastic, the AI handled the paperwork, I didn't have to hire an accountant, and I just saved $100,000. But what happens when the AI misunderstands the tax code, gets the technical narrative wrong, and the IRS rejects that claim? I assume you just, lose the credit and go back to square one.
See, that is the assumption most founders make, and it is entirely wrong.
Yeah.
The executive tax dossiers refer to what happens next as a liability waterfall.
Ooh, liability waterfall. That does not sound good.
No, it doesn't. Because if that $100,000 claim is denied, obviously you have to pay the $100,000 back to the government.
Yeah.
But the initial rejection is just the trigger.
The trigger for what?
The penalties. They immediately kick in. First, the IRS applies a flat 20% penalty for making an excessive claim. That falls under IRC Section 6676. So you are instantly down another $20,000.
Wait, hold on. If I make a mistake on my personal taxes, I usually just have to pay what I originally owed. Why is the IRS treating an AI miscalculation on an R&D credit like I just committed a massive intentional fraud?
Because the IRS views automated, unverified claims not as innocent mistakes, but as a systemic threat to the tax base. They classify it as negligence.
Oh, wow.
Yeah, so on top of that first penalty, they stack another 20% penalty under Section 6662 for negligence or substantial understatement. That is an additional $20,000.
So we're at $40,000 in penalties now.
Exactly. And we haven't even touched the logistical cost of fighting the audit. Tax consultants and specialized attorneys, they charge anywhere from $195 to $395 an hour to defend a company during an audit.
That adds up fast.
It does. Add in automatically compounding interest on the unpaid tax, and you're usually looking at another $25,000 to $35,000 in defense fees and interest.
So if we run that math, the initial $100,000 denial spirals into a total liability of $165,000 to $175,000.
Yes, exactly.
It is actively more expensive to try and fail than to have never filed for the credit at all. It's like getting a speeding ticket where the fine isn't just cash. The police take your car, charge you for the tow, and then audit your driving record for the next 3 years.
That is a great analogy. What's fascinating here is why the IRS structure is built this way. It is a highly intentional dual threat mechanism.
Meaning they designed it to be this punishing on purpose.
Yes. The IRS wants to make aggressive, undocumented AI-generated claims a catastrophic event for any business that tries to cut corners. Furthermore, the data reveals an audit multiplier effect. What's basically every single dollar the IRS spends on enforcement systemically reduces total R&D claims across the broader economy by $2.64.
Wow.
Yeah. A single rejected claim statistically triggers expanded multi-year audits. They don't just look at the disputed year, they open up your books for adjacent periods. The goal is deterrence through overwhelming financial pain.
So if the IRS is weaponizing these penalties to crush undocumented AI claims, I have to imagine the legal battles are brutal. Do we have any recent court cases that show exactly where a judge draws the line between a valid claim and an automated disaster?
We do, and the courts have been setting a formidable, almost hostile standard for taxpayers who lack proper documentation.
Give me an example.
Take the Phoenix Design Group case from December 2024. This was a total disaster for the taxpayer. The court completely rejected their tax credits across multiple engineering projects.
Did they get hit with penalties too?
They did. More importantly, the judge strictly enforced that devastating 20% negligence penalty. The core issue was that the taxpayer's documentation was incredibly weak. They provided zero proof that they were engaged in a systematic process of experimentation.
Meaning they just said, hey, we did engineering work, so give us the money, without showing the actual scientific method of proposing a hypothesis, testing it, failing, and trying again.
Precisely. For decades, there was a legal precedent known as the Cohen rule. It essentially allowed companies to make reasonable estimates of their business expenses if their receipts were messy.
Oh, right.
Yeah, well, the Phoenix Design case proved that the Cohen rule is entirely dead when it comes to R&D.
Yeah.
Because R&D requires a strict scientific process. You cannot just estimate your expenses.
So letting an AI retroactively guess how much time an engineer spent on a project 2 years ago will guarantee a loss in tax court.
Completely guarantee it.
Which brings up the massive George v. Commissioner case filed in February 2026.
Right, yeah.
This wasn't a small engineering firm. This was a massive poultry producer that claimed like $4.47 million in R&D credits for developing things like complex feed additives and new vaccines.
A huge claim?
Yeah, and they relied on a retroactive study, meaning they hired a firm to try and recreate the documentation years after the actual scientific work was finished.
And the tax court tore that retroactive methodology apart. The court slashed their credit rate from a healthy 14% down to just 6%.
Ouch.
Yeah. The fatal flaw in their case was that their primary base period data had been destroyed. Base period data is the historical financial baseline a company must use to prove they are spending more on R&D now than they did in previous years.
And theirs is gone.
Exactly. Because that foundational data was essentially shredded, the court ruled that you cannot mathematically defend a claim. You can't use software to hallucinate a baseline that no longer exists in reality.
Here's where it gets really interesting. Despite the fact that their foundational data was literally shredded and their documentation was completely inadequate, the court actually let the poultry producer off the hook for that devastating 20% negligence penalty we talked about earlier. Wait, if their evidence was that bad, why on earth did the judge show them mercy?
The taxpayer successfully deployed one very specific legal shield. They proved good faith reliance on a qualified advisor.
Oh.
Yeah, because they had human tax professionals actively involved in reviewing the process, even if the ultimate data was flawed. The court viewed it as an honest attempt to comply with the law.
I see.
The courts fundamentally demand contemporaneous documentation. That means data captured in real time as the developer is typing or the scientist is mixing chemicals. But when that data is missing, relying purely on an autonomous AI leaves the company entirely defenseless.
Because there's no human to say, hey, we tried to do this right.
Exactly. In the eyes of the court, the human advisor acts as a literal legal firewall.
A human shield against AI hallucinations. So if you let an AI run your tax compliance solo and it messes up, you pay the ultimate financial price. But if a human advisor reviews the AI's work, signs off on it, and still messes up, the court sees the human effort and waives the negligence penalty.
That's the reality of it, yeah.
If human oversight is a literal legal shield, how are executives actually deploying AI in the real world? Because we constantly hear the narrative that AI is taking over the C-suite, but this legal reality suggests they should be terrified of full automation.
The market data proves that they are indeed terrified. It's resulting in a phenomenon called the C-suite trust paradox.
Okay, what is that?
Based on 2025 executive surveys from major firms like SAP and PwC, 74% of C-suite executives completely trust AI for tasks like data analysis, identifying market risks, and generating internal insights.
So they love it as a glorified reading comprehension tool.
Yes. But when it comes to trusting AI agents to handle core business operations autonomously, meaning no human in the loop to review the action before it happens, that trust plummets to a tiny 6%.
6%, that is a staggering drop-off.
Only 6% of global business leaders are willing to let AI actually drive the car.
And it seems like it's not just a lack of trust driving that hesitation, it's a lack of actual measurable results. I know a 2025 study from MIT looked into this and found that 95% of corporate generative AI projects currently yield absolutely zero measurable return on investment.
Zero. And the core reason for that failure is that companies spent the last 3 years trying to use AI to entirely replace the human worker rather than building systems that assist the human worker.
Right.
We saw this play out dramatically with the failure of horizontal do-everything AI platforms.
I remember an AI presentation tool that went incredibly viral a while back. Tome, I think, what ended up happening to them. They seemed like they were going to replace PowerPoint overnight.
Tome is the perfect cautionary tale. They raised $81 million in venture capital. They had over 25 million users globally logging in to make AI-generated presentations.
Sounds like a huge success.
You'd think so. But despite all that traffic, they couldn't even hit $4 million in annual recurring revenue. They had to shut down their core presentation product in April 2025.
Why?
The problem was their horizontal approach. They targeted everyone from high school students to indie artists to tech founders, building a tool that made visually pretty but functionally generic slides. Yeah, they had zero willingness to pay from enterprise clients because a generic hallucinated slide deck does not survive in a high-stakes corporate environment where a single wrong metric can tank a deal.
It's the difference between buying an autopilot system for a toy drone versus a commercial airliner. The drone AI can afford to crash into a tree, nobody cares. But a commercial airliner's AI cannot just focus on flying. Its primary feature is proving to the FAA and the pilots that it absolutely will not crash. Are we seeing startups shift to that airliner model?
If we connect this to the bigger picture, the market is aggressively shifting toward specialized, highly regulated models. We call this the AI governance premium.
The AI governance premium?
Yes. Executive trust in autonomous AI isn't low because of some irrational fear of new technology. It is the correct, logical, mathematical response to strict regulatory liability. You can see this market adaptation in companies like Prisia.
How are they different from Tome?
Well, instead of making generic slides for the entire internet, Prisia built an AI agent that operates natively inside Microsoft PowerPoint, specifically and exclusively for high-end MBB management consultants.
MBB, that stands for McKinsey, Bain, and Boston Consulting Group, right?
Yes. These are professionals who require absolute, verifiable precision and strict adherence to corporate brand guidelines. Because they solved a high-stakes specialized problem, Prisia hit $270,000 in recurring revenue in just 3 months.
So they essentially built a surgical tool for specialists who are terrified of making a mistake.
Exactly. Another great example is Maniac, Inc., and their fiber platform. They completely avoid promising magical, autonomous AI dashboards that run your company.
What do they do instead?
They focus entirely on fine-tuning AI models on a company's pristine private data within their own virtual private clouds, meaning the data never leaves the company's secure servers.
Right.
They do this because there is a very old rule in enterprise software that the AI industry is painfully rediscovering, which is AI will not save you from bad ERP data.
Let's clarify ERP data for a second. That stands for Enterprise Resource Planning, right? Essentially, the massive, messy, chaotic ledger of invoices, vendor payments, and supply chain records a company generates every day.
That's the one.
If that foundational data is garbage, and AI hallucinating on top of it is just making terrible business decisions at the speed of light.
Exactly. The value proposition of enterprise AI is no longer about bypassing the human executive. The real value is in creating infrastructural intelligence, systems that gather and clean data perfectly so the human executive can audit it, trust it, and legally own the final decision.
Let's bring this demand for specialized, human-shielded AI back to the R&D tax market we started with.
Great.
How are companies actually building software products that survive an IRS audit while maximizing their financial returns? Because looking at the landscape, there are essentially three different strata of R&D tax providers right now, and they all offer wildly different liability profiles.
That is a great way to frame it. At the first level, you have the legacy Big Four accounting firms, Deloitte, PwC, EY, and KPMG.
The heavyweights.
Right, they offer extremely high corporate trust because they rely on massive teams of human accountants. But because they're heavily manual, they're slow, incredibly expensive, and hyper-conservative.
Meaning they don't claim as much.
Right. They routinely leave 30% to 50% of a company's eligible tax credits on the table simply to avoid any hint of audit risk.
Wow. Then at the opposite end of the spectrum, you have the tech-only platforms. These are your pure Silicon Valley startups, companies like Main Street or NeoTax. They are AI first, incredibly fast, and fully automated.
But as we just learned from the liability waterfall, fully automated means you have no human shield.
Exactly. They are frequently criticized by traditional tax professionals for generating aggressive claims that lack the contextual nuance an auditor demands. It is high reward, but massive risk.
Which brings us to the third tier, the hybrid AI contenders. This model is currently dominating the verified market. A prime case study of this market adaptation is a company called Bose.ai.
How did he do it?
They realized early on that the only way to win in a high-compliance environment is to combine the data ingestion scale of AI with mandatory in-house human oversight.
And from an objective standpoint, their architecture seems to be solving the exact problem that doomed the poultry producer in the George case. How exactly does their software prevent a company's base period data from getting shredded or lost?
They avoid retroactive studies entirely. Instead, their AI architecture integrates natively and in real time with a company's actual daily workflow tools.
So it's plugging right into their systems.
Yes, it connects directly to Jira, which is the software developers use to track their daily and engineering tasks and bugs. It connects to GitHub, which is the central repository where the actual software code is written and stored. And it connects to payroll systems.
That's a lot of data.
It is, but the AI works silently in the background, automatically pulling timestamped code commits and clustering Jira tickets to prove definitively that a specific engineer was typing and testing new code at 2 p.m. on a Tuesday. It captures the experimentation contemporaneously.
But the AI itself does not push the button to submit the claim to the IRS.
No, and that separation of duties is their crucial firewall. The AI builds the massive, mathematically perfect data trail. But Bose employs in-house human tax experts to manually review that AI cluster data and write the required technical narrative.
Got it.
Yeah, the human writes the document that proves the technological uncertainty and the systematic experimentation required by law.
It is also worth noting the regional differences in how these credits are paid out, which elevates the stakes even further. Bose operates in both the U.S. and Canada.
Right.
In the U.S., under IRC Section 41, the R&D credit is generally a 20% non-refundable credit, meaning it just offsets your future tax bills. But in Canada, their SR&ED program offers a massive 35% refundable cash credit for early-stage startups.
It's a huge difference.
Yeah, if you are a Canadian startup burning through runway, the government will literally cut you a physical check. It is a critical lifeline, making flawless compliance a matter of survival.
But even this highly effective hybrid model is facing a looming existential crisis. And this brings us to the absolute bleeding edge of the industry. In January 2026, KPMG issued a major warning regarding a new software development trend called vibe coding, also known as agentic coding.
Right, vibe coding. This is the shift where human software developers aren't actually typing out lines of code anymore. They are just writing a plain English prompt, and an autonomous AI agent is independently writing, testing, and refactoring the software code until it works.
And that creates a massive legal paradox. The IRS tax code, specifically Section 41, explicitly requires a human-driven, systematic process of experimentation to qualify for an R&D credit.
So what does this all mean? If I tell an AI agent to build me a mobile app, and the AI autonomously tries 10 different ways to code the login screen, fails 9 times, and finally gets it right on the 10th try, who actually did the experimenting? Who gets the tax credit? The human who wrote the one-sentence prompt, or nobody at all?
This raises an important question, and it is exposing a massive compliance gap in the current law. The semantic rules of what constitutes research and development are actively shifting beneath our feet.
How is the IRS responding?
Well, the IRS recently released a new 2025 version of Form 6765, which is the primary document for claiming R&D credits. This new form demands hyper-detailed business component disclosures up front. They want the specific human context behind the science.
So you can't just auto-generate an explanation.
Exactly. If an AI autonomously generated the software code, and then you use another AI to generate a generic text template to describe that code for the IRS, is going to fail that primary screening immediately.
Because there is no deep technical substance or human hypothesis behind it. The IRS is actively filtering out automated template generation.
Software automation alone cannot defend against an evolving tax code. The human context isn't just a nice-to-have feature for quality control. It is a strict legal requirement to prove that genuine innovation occurred.
Which brings us to the ultimate takeaway for you, the listener. Whether you are leading a boardroom strategy session or bootstrapping a tech startup, or you are just fascinated by the messy intersection of law and technology, the lesson of the last few years is incredibly clear.
It really is.
The future of enterprise AI is not full hands-off autonomy. Human friction is a feature, not a bug. In high-stakes compliance, AI is the ultimate forensic data aggregator. It can ingest and organize millions of GitHub commits and payroll records instantly. But the human must remain the final arbiter of truth. You want the AI to do the heavy lifting, but you absolutely need the human to hold the shield.
Well said.
Before we wrap up, I want to leave you with a final thought to mull over. We've spent this entire deep dive talking about corporations using AI to defend themselves against the IRS. But what happens in a year or two when the IRS and the Canadian Revenue Agency deploy their own autonomous AI agents to audit these claims at scale?
Oh.
Are we heading toward a future of automated financial warfare, where your company's AI agent has to argue in legal code against the government's AI agent, while the humans just watch from the sidelines? Imagine that speeding ticket where the robot cop just automatically freezes your bank account. Something to think about. Thanks for taking the plunge into today's deep dive with us. We'll see you next time.